right, market update. We're going to hit Bitcoin and 10-year Treasury today with some 3 to 6 month outlooks. So starting with Bitcoin, you should keep an eye on this one because recently it's the leading indicator of the market. Bitcoin trades 24 hours, so there's always going to be more information out there, and you kind of get a jump on the regular market based on Bitcoin's actions. So what we're looking at now is 25%, and that's still, I think, a little bit high. It's just the volatility is so much, I had to give it a little bit extra, that we're going to get back up there to those 106, 108, numbers. And reason being is it's already had 2 attempts that never made it there. It tried earlier in the year, had a second attempt and failed. And now that we've kind of broken through the significant level, it'd be very hard to get everybody back up there. So I think 3 to 6 months, 25% that we even get up to that number, let alone break a new high. The more likely scenario is scenario 2, where we're going to end up down in the 60 to 65,000 range. And I know people get upset when I make these predictions. I'm not trading any of these. This is not where where I want things to go. It's just based on charts, historics, and everything else. This is realistically, it's the charts plus the overall financial view of country, the market. It's a lot of factors that go into this. It's not just the squiggles on the paper here, but more than likely, if we don't get above that 90,000 range and stay there within the next 3 weeks, that is a significant chance we're going to end up down in the 60,000 range, because listen, Bitcoin is a store of value, just like anything else. And if people don't have discretionary money aside because of all the other factors going on, it's going to be one of the first things that get cut after the budgets and things. People are not going to be able to trade this as much. And then you now have 2 markets. You have someone who bought at 100,000 thinking it's going higher, watching their stuff go down to 60. And this is where market transitions happen, right? They always take money from one and give it to another, right? The market is there in some ways to screw people over. There's nothing else to say about it. When you think you're going to do something you're going to miss the boat on, that's when you're going to get screwed. And it's going to be the same thing to the downside. When it starts getting to that 60 range, people are going to panic that it's going to go down to 0. And that will start your next pattern that plays out. And the reason this doesn't add up to 100, because we still have some probabilities that it's still early in this trend. And a lot of times you'll get a big breakdown and then a snap back up. So really waiting to see where this snap up goes, because we've had it over the past couple of days. If we end up much, much higher and sustaining that 90,000, we could probably be range bound for a little bit, where, we're going to bounce between, 98 and 85 kind of for a few months while the market makes up its mind. All right. So for the good news on the 10-year Treasury, we don't see a big chance of a break to the upside anymore. That run we had from December up has kind of been stalled. Realistically, we have a neutral to down chance with a really significant chance we break to the downside. We're going to have these big runs up, but then the economic news is going to come out and kind of recenter the market. So very significant chance that the 10-year gets back down to where it was in December over the next 3 to 6 months, which will then put the rates back into the mid to high 5s. And then the overall economy will start getting stronger, because that will open up refinances and things like that. I'll get into the fundamentals in the next video, but realistically, that X is where we need to be on the Treasury, because that's where the world is going to start to feel a little bit better. Half of the world, not the whole, because if you don't own real estate, you're not going to have as many options. But for the most part, this is why we'll have this sort of staggered recession, because different people are going to feel it in different ways. Okay, in 10-year option 2, scenario 2, realistically, is if there is some sustained pressure with tariffs and things like that, that we get another run up to that 4.8 mark. I put that at about a 30% chance. That's still a little bit high. Breaking over that would be it would be something external that would cause that, because we're not in a spot where we have to worry about inflation. I think we're more in a deflationary time. So there's still a chance of it, because of the fact that we held at this 4.10 mark. But if we get a run up to, say, mid 4s again, another failure would be significant. And then we'd be more likely again to get down to that 3.5, 3.6 range that we needed. But there is still a little bit of that upside potential. Just the longer we go where we're not snapping back up, the better it is for the 10-year Treasury and the housing market and everything else. So fundamental update to follow. Enjoy, guys.